Welcome to Echo 315, Study Session 5, Capital Market, Introduction. In the just concluded session, we explored the forms of financial assets. We will now examine the capital market and the new issues of securities. Learning outcomes. When you have studied this session, you should be able to 1. Discuss the two major avenues through which investors can buy and sell shares. 2. Explain some of the benefits investors derive from investing in the capital market. 3. Describe the regulations and operations of the Nigerian capital market. 4. Discuss procedures involved in procuring a new share. Introduction to capital market. The capital market is a market for long-term funds. Capital market instruments can be categorized into three major groups of securities, namely debt instruments, preference shares, and ordinary shares. Apart from serving as a source of raising long-term funds, investors also approach the market to create wealth through investment in instruments traded in the market. Buying and selling of shares. There are two major avenues through which investors can buy and sell shares. They are the primary and the secondary markets. The primary market provides for only buying of shares or other capital market instruments directly from the issuing company. On the other hand, the secondary market enables investors to trade in securities which had earlier been issued in the primary market, symbolized by the stock exchange. Thus, this market provides a mechanism which enables investors to buy and sell existing securities. Investors can therefore buy and sell shares through a stockbroker who trades on these shares on the floor of the Nigerian Stock Exchange with the provision of market facilities by the exchange. Investment benefits. The primary aim of an investor is to get a good return on his or her investment. Investing in the capital market goes with a lot of benefits and prospects if investment decisions are wisely taken. In taking investment decisions, you consider the viability of the company in which you wish to invest by critically analyzing its fundamentals, past financial performance, management structure, business environment, market competitiveness, economic environment, and of course, political environment, amongst others. The benefits which investors derive from investing in the capital market include the following. Capital appreciation. This entails the difference between the price at which a share of a company is bought and the price at which it is sold. Dividend payment. Shareholders are entitled to dividends if declared. Dividend is proportionally based on per share, which means as much shares as an investor has influences more dividend that will be expected. Bonus issue. Shareholders are also entitled to bonus issue if declared. Depending on the rate declared, it enables a shareholder to acquire additional shares from the company where he invested in, without necessarily paying for these shares. Right issues. Shareholders are opportune to participate in right issue of the company where they invested. Although right issues are paid for by the investors, the price is usually lower than the prevailing market price. Participation in decision making. Shareholders have the right to attend the annual general meeting of the company which they have invested in. Participating in decision making and exercise voting right. Investors can use the share certificate as collateral to obtain bank loans for individual use or business development. Preparation towards personal pension plan. Buying of shares could be used by an individual that is preparing towards personal pension plan. This in the sense that an investor who is opportune to invest considerably in the stock market during his earlier age could completely rely on his investment as a means of income at old age. The daily activities or transactions carried out at the capital market are regulated by institutions set up by the government to efficiently manage the affairs of the market. The Security and Exchange Commission, with its sister regulatory institution, that is the Nigerian Stock Exchange Market, a self-regulatory organization, and the Central Security Clearing System, are vested with the responsibility of ensuring the proper functioning of the capital market through the formulations and implementations of guided policies. With the necessary regulatory framework in place, investors in the market are well protected of their investment. The apex regulatory institution of the Nigerian capital market. It is a statutory body supervised by the Federal Ministry of Finance. The Commission has evolved over time, having started with the establishment of the Capital Issue Committee in 1962 as an essential arm of the Central Bank of Nigeria. The Statutory Committee, which later metamorphosed into Securities and Exchange Commission (SEC) in 1978. The functions of SEC include the following: regulation of investment and securities business in Nigeria, capital trade points and clearing companies, protection of investors in the market, registration of orderly, fair and equitable dealings, approval and regulations of collective instrument schemes such as unit trusts, pension funds, and so on. Nigerian Stock Exchange. The stock exchange is a marketplace where listed securities of varying types are bought and sold. The Nigerian Stock Exchange is the center point of Nigerian capital market. It provides a mechanism for mobilizing private and public savings and makes such funds available for productive purposes. The exchange does assist in the allocation of the nation's capital resources among numerous competing alternative uses, thus serving as an aid in the financial industry. The Nigerian Stock Exchange was established in 1960 as the Lagos Stock Exchange. In December 1977, it became the Nigerian Stock Exchange, with branches established in some of the major commercial cities of the country. The Nigerian Stock Exchange basically provides marketplace and facilities for trading of securities in the secondary market. It is vested with the responsibility of controlling and regulating quotations on the exchange, as well as correlating the stock broking activities of members. The exchange presently has branches in the main cities of Nigeria, such as Abuja, Kaduna, Port Harcourt, Kano, Onitsha, Ibadan, Yola, and Benin. Central Securities and Clearing System (CSCS). To aid effectiveness in transactions on the floor of the Nigerian Stock Exchange, the Central Securities and Clearing System (CSCS) was set up on the 14th of April 1997 with the main purpose of clearing and settlement of trades for the Nigerian Stock Exchange. Consequently, the settlement cycle reduced with effect from March 2000 from transaction day plus 5 days, that is T plus 5, to transaction day plus 3 working days, T plus 3. The primary market is the market where the securities are sold for the first time. Therefore, it is also called new issue market. In a primary issue, the securities are issued by the company directly to investors. The company receives the money and issues new security certificates to the investors. Primary issues are used by companies for the purpose of setting up business or for expanding or modernizing the existing business. The primary market performs the crucial function of facilitating capital formation in the economy. The new issue market does not include certain other sources of new long-term external finance, such as loans from financial institutions. Borrowers in the new issue market may be raising capital for converting private capital into public capital. This is known as going public. The primary market provides for only buying of shares or other capital market instruments directly from the issuing company, which could be through initial public offer (IPO), offer for subscription, right issue, and private placement (ETC). The price at which shares are bought in this segment of the market is usually lower than that of the secondary market. Initial public offer (IPO). This refers to a company's first ever sale of shares to the public. It is the first offer a company makes to the public to raise money through a stock exchange. An IPO would necessarily come from a previously private company that is now ready to go public by allowing other investors to introduce capital and become members. The company bringing such offer is hardly well known, in the sense that, as a previously private company, it had no obligation to publish its accounts or meet any of the corporate governance obligations of public companies. In terms of market trading, there is no track record to rely on to evaluate and project. Various other parameters are absent. For instance, no dividend payment history to judge dividend policy. Thus, an IPO is a high-risk investment. However, not having a track record and other factors could lead to a depressed pricing, meaning that significant appreciation can occur in the nearest future. The IPO could therefore represent a hidden investment opportunity. Private placement. This is another avenue for a company to raise capital. In private placement, the offer is privately presented to a limited number of investors, as opposed to an offer that is open to the public. Usually, this is targeted at well-yield investors, including fund managers and institutional investors. Overall, this is more flexible for issuing company, since the cost of marketing and administering the offer is lower. It also offers a relatively quiet way of testing the reaction of the market to the company offer. If you are invited to invest in a private offer, it means that you match the profile of investors the offer is targeting, which is good for you. A company will not go for this option if it has no prospect of attracting enough funds from the target group. The pricing may also reflect the savings in issue costs, giving some benefits to the investors. Public offer. This is obviously the king of all offers, the one for everybody, and where you most likely have a good basis for evaluation. Unlike an IPO, the company is already listed and traded on the stock exchange. Thus, the company has a market history and its operational results are usually made available to the public. A public offer is an offer of shares to the public at large, meaning that any interested investor can buy into the company. It is usually subjected to strict screening exercise by the regulators, since the general public is expected to invest. Right issue. This is used by companies that want to raise money exclusively from its existing owners. It is close to a public offer, only with the limitation that only existing shareholders of the company can buy. This may be designed to avoid diluting ownership or to keep benefits within the family. Usually, such offers are at a discount, which gives the shareholders an immediate benefit. Rights are offered to shareholders in a certain proportion to what they already own, and each shareholder's entitlement is communicated to him through right circular. It's common to have a hybrid offer, that is, a combination of public offer and right issue. Most times, there is a pricing benefit with right issues being made at a discount. Besides, the right beneficiary is already a shareholder and presumably familiar and comfortable with the company. It's therefore easier to evaluate the offer. Also, a right issuer is, by implication, already a public company subject to higher regulatory scrutiny. A right issue immediately gives a benefit, since you can sell your rights even when for any reason you cannot invest in the current offer. Summary. In this study session, you were exposed to the Securities and Exchange Commission, SEC, which is the apex regulatory institution of the Nigerian capital market. The Nigerian Stock Exchange is a center point of the Nigerian capital market. Clearing, settlement, and delivery of transactions on the exchange are done electronically by the Central Clearing System Limited, CSCS. The primary and the secondary markets are the two major avenues through which investors can buy and sell shares. The primary market provides for only buying of shares or other capital market instruments directly from the issuing company, which could be through an initial public offer, IPO, offer for subscription, right issue, and private placement. The benefits which investors derive from investing in the capital market include capital appreciation, dividend payment, bonus issue, right issue, participation in decision making, collateral for obtaining loans from the bank, and preparation towards personal pension plan. This is the end of study session 5. Thanks for listening.